Welcome to Investment 360. In the hot seat this evening, Henk Potts. He is Director of Global Research and Investments at Barclays Wealth, joining us live from London. Henk, good having you on the show. Let's start with your view on what we can expect to see out of Europe tomorrow. Of course, the market is waiting with bated breath. Wayne saying that we're not going to see the detail that we are expecting.
Well, it may not be too far from the truth right there. Quite frankly, what we've seen from officials in Europe so far is over-promising and under-delivering, and there's every fear that that could happen tomorrow. Three main areas I think that the market's looking for clarity on. Number one, of course, the level of write-down in terms of Greek debt. Now, you remember back in July that private investors, the banks, would agreeing to a figure around 21%. Suggestion is that could rise somewhere between 50 to 60%. If that turns out to be the case, then that moves us on to the second issue, which is, of course, the recapitalizations of the banks. Now, if it was to be 50, 60%, you could easily get to a figure of 100 billion euros. Then the question is, where does that come from? I think they'll hope there's a market solution. It'll then likely be a national government solution, and eventually the lender of last resort is likely to be the European Financial Stability Facility. But of course, the biggest area of concern, the biggest area of disagreement is how to scale up the European bailout mechanisms, giving those the financial firepower required. And if we don't get clarity on those three major issues, then you can see investors drowning in a sea of red tomorrow, bond yields rising, uncertainty and contagion being the major themes.
But Henk, isn't this all just politics at the end of the day? Isn't it just an absolute fait accompli that they're going to have to come with a rescue package, because the alternative of not doing a proper package is actually so ghastly no one can even contemplate it? Aren't they? Isn't it just inevitable that they'll come with a package?
Well, listen, you hope that's the case, but the reality is what makes good economic sense doesn't always make short-term good political sense. And that's what they're trying to balance out at the moment. Because the truth is there is a price to be paid for some of these measures, and it looks like Germany's going to be picking up the tab right there. And two reasons why they're a little bit concerned, or why the German public aren't happy. Because as creditors, they're paying for debitors. So while Germany's been saving, the Greek public has been out there spending freely, living well beyond their means for far too long, and now they've been left with the tab. And I suppose that you're going to see an element of a European-wide body taking control of fiscal policy across the European Union. That results in them giving up some of their sovereignty, again, something they're not really prepared to do. So it's taken us to this point of crisis before member nations have started to agree these very necessary measures.
What about France? And of course, the latest bit of drama last week coming courtesy of France, and the fact that it could potentially lose its top credit rating. President Nicolas Sarkozy has come forward himself saying he's going to take steps to reduce the deficit to protect the credit rating. What are your thoughts on that front?
Well, listen, there's some internal measures that France can take to try and calm market nerves, but the truth is, and the reason why they're being so aggressive revolves around the way in which the European Financial Stability Facility is set up, or how it's going to evolve given that extra financial firepower. France is saying, listen, what we want is it to be a bank, effectively, a bank that's able to access European Central Bank liquidity and work it from that perspective. But if that's the case, then potentially that does threaten their AAA rating. Now, Germany, on the other side of the coin, say, listen, we don't want it to be that. We see it as an insurer. We see it as something that can guarantee a portion of potential losses on new European bonds, and that stretches out the facility probably to something like €1 trillion. So it's that area of debate that's absolutely crucial. But you highlight one of the significant points. The reason why France are being so aggressive is because that all-important AAA rating is certainly under threat.
Now, Henk, I mean, maybe it's a silly question because the horse has already bolted. How did this, let's call it the Greek tragedy, happen? Surely the whole idea behind the European Union is that there are policemen, bureaucrats looking at government expenditure, and that deficits should not have been allowed to get to this level. So although the Germans are choking on this, they're also responsible because they didn't keep an eye on Greece, putting it simplistically. So how How did this actually happen that Greece lived beyond their means for so many years and it wasn't apparent to anyone else in the European Union?
Well, you highlight one of the significant problems when the Eurozone came together, when the single currency was initiated. The great clamber was for this idea of monetary union, the fact that it'd have a single interest rate across the Eurozone. But somehow everyone forgot alongside that, in order for the system to work, you also need fiscal union. And of course, it's only during the bad times do these things come to light. And of course, with the economic downturn that we've been seeing, given the fact that we've seen public borrowing absolutely exploding, we've seen government debts go through the roof, then of course, the situation becomes unsustainable. And given the fact that Greece has been way outside any normal fiscal rules for an awful long time, effectively lying about their fiscal position for an awful long time, then they of course were the first to suffer.
Henk, just looking at market indicators, we've got the S&P and the Dow both close to 1% lower at this stage. And of course, we had that negative consumer confidence data point out today, where consumer confidence in the US is the lowest since March 2009. With all the focus on the Eurozone, have we been forgetting about the trouble in the US?
Yeah, I think, listen, there's two sides to it. As you say, the Eurozone needs proactive action from European officials to solve the crisis. I think what we can say about America is the authorities have been very aggressive, very innovative, very proactive in terms of coming up with solutions. So far, they haven't been rewarded for their bravery. As you say, there are still some major concerns when you look at the data points. Consumer confidence poor today. The housing market still looks very weak in the United States. Case-Shiller survey today saying house prices down by more than 3.5% in the major metropolitan cities over the course of the past year. So big concerns that actually the recovery hasn't been as strong as anticipated. Remember, at the start of the year, we were talking about growth in the United States of 3%. We'll be lucky to get somewhere around 1.7% at the end of the year. The good news, I suppose, is that the second half looks a lot better than the first half. Petrol prices have been falling. Borrowing costs are down to historically low levels. The recovery that we've been seeing in Japan, the all-important supply side of the equation for US manufacturers has certainly been improving, coming back online quicker than anticipated. So I still believe we could probably talk about growth of 2% in the second half of the year. And of course, alongside that growth, you've got more stimulus, more initiatives being pumped into the US economy, particularly focusing on employment creation. And that is going to be the key to turning consumer confidence around and getting the all-important American consumer out there into the shops. So I think we can be a little bit more positive, but as you say, we do need to start seeing companies becoming more aggressive, becoming more positive and out there hiring.
I think two questions. Number one, maybe a little bit of a technical question. You've got this big gap between Brent crude and let's say another benchmark, WTI. Is this just the Libyan premium? I mean, Brent crude is trading about, what, 20, 25 odd dollars higher than West Texas. What's your view on that? But maybe more importantly, what's happening in the UK with inflation? Is that number going to come down at some stage in the not too distant future?
Well, you're right to highlight the problems. Let's start off with the first question in terms of the oil market. Now, we have seen a significant differential being placed in terms of Brent crude over WTI. I think that is to do with some of the geopolitical concerns that we've been seeing out there. So eventually one would suspect that that's likely to narrow. Oil prices, of course, have been rallying significantly over the course of the past few trading sessions. And we still believe that actually oil prices will remain relatively firm in the medium to long term. So for next year, for Brent, for example, we've got an average price of $115 a barrel. If you look out to 2015, for example, I think we've priced in somewhere around $135 a barrel. So still remain optimistic about demand for oil, but that differential should come back and should narrow a little bit. In terms of your second question, well, inflation continues to be a significant problem here in the UK, driven by higher food and energy prices. We're also seeing the effects of the increases in taxes that we've saw introduced at the start of the year. That, of course, has pushed CPI, I think, to 5.2% last month. If you look at RPI, I think it's up to 5.5%. But I think as you look into 2012, you'll start to see the base effects coming through. You'll start to see some of those one-off measures taking out of the inflation number. So if you listen to the Bank of England, if you look at consensus forecasts, then I think you'll start to see inflation moving back towards 3% during the course of 2012 and heading back towards the target of 2% sometime after that. In terms of its ramifications, actually quite interesting, because the September rate is the rate at which, of course, pensions and government benefits are set, so that'll be important for next year. But in terms of its ramification for interest rates, rather limited, you have to say. Quite frankly, the Bank of England has almost given up trying to fight inflation, at least in the short term. They tell you, listen, the recovery is far too fragile. So despite inflation at 5%, against a government target of 2%, rates are set to remain on hold. In fact, if you look at interest rate expectations, we've now pushed out a rate rise in the UK well until 2013.
Henk, how concerned are you about the potential systemic banking risk that could emanate from Europe? And I'm always amazed when people tell me that Dexia came out at the top of the bank stress tests.
It certainly does call into the question the veracity of some of the European stress tests that we have been seeing, that officials have been conducting. Although, to be fair, I think while they weren't particularly onerous in terms of the hurdles that I had to overcome, it did add an element of transparency which other market forces were able to use. So I suppose they've been relatively helpful in that regard. Listen, fundamental in terms of the solutions that we hear tomorrow is the effect that it has in terms of the European banking sector. Now listen, we've done a lot of research in relation to this, and we've taken a worst case scenario. So what we've done is we've looked at the effects of a 50% write down of all peripheral debt. So that's not only the likes of Greece and of Ireland and Portugal, but we've added in Italy and Spain as well, the Eurozone's third and fourth largest economy. Now, if you were to see a write-down, as I say, of somewhere around 50%, it's very easy to argue that the European banks would require somewhere around 300 billion euros in terms of new capital. So then again, we come back to that age-old question, where's the money going to come from? Well, if it's left to individual nations to solve their own domestic banking scene, it'll be unmanageable. If you look at Spain, for example, you could easily generate a figure of 11% of GDP. Now, that is unsustainable. However, if you were to take it from a European perspective, then actually the figure comes down to 2% of GDP, and that is manageable. And that is why we need to see a coordinated approach to solving these European issues across the board, rather than leaving it to individual, particularly indebted nations.
But I mean, Henk, it certainly means a lot of disgruntled German voters. But let's put that aside. Let's move to China now. Generally speaking, some good news out of China in the last while. Do you think it's sustainable? I mean, obviously, this is so important for South Africa and in particular our stock market. Is there no inherent problem? What about inflation? Does the currency appreciation bring down the Chinese inflation risks?
Well, we're starting to see the renminbi appreciate slowly but surely, so I think that's a process that's going to continue to happen. You're right to point out inflation as a major concern for China, as it is for other emerging markets. Inflation's been above 6%. The good news is that authorities have been proactive. They've been draining cash aggressively from the economy. They've been increasing the reserve requirement rates at the banks and, of course, raising interest rates. Our expectation is that inflation will peak during the course of this year and then start to moderate. So some good news in relation to that. Local government debt is probably another area of concern that I think you've got to watch very closely. And of course, the housing market. We've seen a significant bubble. Some of the major cities develop, and that needs to be cooled. But we're starting to see house inflation come down. In fact, I think it's at its lowest level in 2 years last year. So we still remain quite optimistic. Chinese growth came in at 9.1% for the third quarter, so still incredibly impressive, although down from the 9.5% that was achieved in the second quarter. In terms of the medium term, we do still remain very optimistic about growth coming through from China. We still believe that they'll be able to generate growth of above 8% per annum over the course of the next 5 years. So we're still recommending to our clients that they should have exposure to Chinese equities. They should be trying to gain exposure through, I think, exchange traded funds or buying into the relevant mutual funds. But then I suppose the question is, when would you exit that strategy? Well, I suppose if growth or earnings forecasts came down dramatically, we don't see that as being the case. If concerns start to increase about public debt levels and inflation, again, not our central scenario. And to watch out for, of course, if markets do rally, then you start to see valuations much closer to their
Henk,
peers. None of that
thank you very
seems
much
to be the
for
case
your
at the
time.
moment.
We've run out of time. Thank you so much for that enthusiastic recount of the scenario that we're facing globally. Henk Potts from Barclays Wealth. We're also saying goodbye to our guest host, Wayne McCurry from Momentum Asset Management.